Hij is talking. Hij is live. Ik heb net gezet presentation uitgaan.
Ladies and gentlemen, good morning. May we start? Good morning, ladies and gentlemen. Goeiemôre, dames en heren. Molweni. My name is Nico Coetzee, and it's a pleasure to welcome you all on behalf of PPS and the University of Stellenbosch Business School. It is lovely to see you back after the winter break, and it is Nico and I were just talking. Lovely to see such a huge turnout this morning. So you're most welcome. Ladies and gentlemen, I mentioned that this is a sponsored event by PPS. Our thanks to PPS for supporting our Leaders Angle series. And then I'm going to introduce Nico Coetzee. He's been here before with us. He's very knowledgeable in his field, and he's going to talk about something that interests us and concerns us all. So, Nico, over to you. Looking forward to it.
Thank you, Marita. Good morning, Dumela. Thank you very much for coming through on this wet, dark morning, especially on a Friday morning. I really appreciate it. I'm really here today to tell you guys a story. And I think it's a story that we will all be able to relate to. Well, that's my hope and my intention. And before I just start, thank the University of Stellenbosch for allowing us the opportunity to talk to you this morning. PPS has a long history of dealing with the various universities around South Africa, specifically being focused on graduate professionals, and it's especially wonderful being able to talk to people of your caliber. Okay, so let's get into it. So I'm going to tell you a tale of two professionals. And before I do that, I'm going to set the scene, just so that we know exactly what the environment is that we operate in. Then I'm going to take you through I'm going to tell you the tale, we'll go through the story, and then we'll look at two endings. One happy ending and one not so very realistic, unfortunately, ending. Not so happy, very realistic ending. And then we're going to start again by looking back at the future and look at what are the lessons that we've learned from these two professionals that I think we can all relate to. Okay, so what is the environment that we are currently living in? So first of all, what we're seeing globally is that global growth is very low. So we see low single-digit returns. Don't be fooled by the sub-Saharan Africa number. Our number is significantly low in South Africa. We were quite fortunate with the decline in the oil price. That actually gave our GDP a very nice boost. Unfortunately, our friends at Eskom took that boost away, and we estimate that the gains that we got because of the drop or the decline in the oil price were more than offset by the energy issues we had that were created by Eskom. So we're looking probably in South Africa at a growth of around 2% for 2015. But globally, we see growth is very low. So the economy is come down. We've seen many issues affecting the global markets. South Africa, we've got our own particular challenges with an equity market that's fairly overcooked at the moment. So it's not an easy environment to be living in, especially when you're looking at the financial side. Times are tough. This is the savings monitor that was conducted by Old Mutual last year, and we can see by and large the majority of South Africans are either finding it or just about getting by or finding it quite difficult. Not many of us of the people that were surveyed, that it's a sort of reflective sample of South Africans, are really living comfortably. And that's obviously affected people's ability to save. So we can see that household savings, 38% of people are saving less than they did a year ago. And we can see the impact of the global financial crisis in 2008 with the spillover. We're now only starting to see the big effects of that. And the expectation is that these numbers will actually go up. So more people are going to save less, which is obviously quite concerning. This has also affected retirement provisions. So we can, if we look at what percentage of people are making a contribution either to a pension or provident fund or to a retirement annuity. And we can see it's relatively low. So even people that are earning 20,000, between 20,000 and 40,000 per month, 16% of them are making no contribution whatsoever to a corporate retirement fund or to a retirement community fund. So that is very concerning given what's happening in the world, especially around retirement. The other issue that we face, not only as South Africans, but generally as investors, is that we are generally poor at investing. So these are some numbers that were done over the last 20 years, where they actually compared the performance of the average fund in the market to the return of the average investor. And what we see is that investors on average get much, much lower returns than the average fund. So Aussies are particularly poor investors, which is nice to see, I guess. In South Africa, we're not quite as bad as the Aussies, but we only get half, or in the States, they get half of the average fund. In South Africa, just under half of what the funds or the market actually gives you. Now the question is, why does that happen? It's because people try and time the market. They try and jump in and out of funds when they think the market's going to go up. They try and sell, and when the market goes down, they try and buy. Unfortunately, often the exact opposite happens. And that's why, depending on which survey you look at, generally speaking, only 6% of South Africans can retire. So, growing old is not for sissies. I don't know many 70-year-olds that, if you still look like that at 70, you've actually done fairly well, I think. All that, so yeah. And it's because we underestimate the impact of these small mistakes we make along throughout our lives. So people often think that when they get to retirement, they've made one massive mistake. Oh, I should have done this. But actually, it's the accumulation of a number of small mistakes. So what I want to do today is go through the life stages of two doctors and look at these little mistakes, little things that we think, you know what, I'm not going to save this 250 Rand now because it's, what's the big deal? So I'm going to show you the impact of these small mistakes and how the cumulative effect actually works against you, and what then happens when you actually get to retirement. This is from a guy called Carl Richards. He wrote a book called The Behavior Gap, and he tries to, basically he says, he tries to help people or prevent people from making stupid investment mistakes. And this is one of his sketches. He said most people get greedy and then they buy, then they become fearful and they sell. So that's a very good strategy if you repeat that until you broke. So I'm going to try and give you some tips to avoid falling into that trap and avoid becoming that part of that statistic of 94% of people that can't actually retire. Okay, so let's get into it. Okay, so we're going to follow two doctors through the life stages, evaluate how seemingly small financial decisions and have a major impact on their ability to achieve their objective. And what is our objective? So when we're engaging with financial advisors or financial planners, we're looking at our own financial situation. What is the thing that we're really trying to achieve? Well, really, we're just trying to maintain or improve actually our standard of living. That's really what we focused on doing. And the life stages that we're going to go through today, and these are the life stages that we define at PPS, is look at people from when they're a student, when they become young professionals, established, senior, and then retire. So those are, broadly speaking, the 5 life stages that a graduate professional goes through. And these are the two doctors. So the first doctor is Dr. Peter P. Sharp. He studied medicine at Stellenbosch with Dr. Blunt, Dr. Ian B. Blunt. They both started working as GPs at the age of 25. Dr. Sharp appoints a lifestyle financial planner to work with him throughout his life on his finances. Dr. Blunt, really, he relies on people calling him to sell him product. That's his approach to his finances, which is, I think, broadly speaking, what most South Africans, that's their approach in generally apply. We wait for people to call us, to talk to us about our finances. And just before we get into it, for the more technically astute, or those of you that are engineers that want to know the numbers that sit behind the calculations. So I've said initially they both wish to retire at the age of 65. I've assumed inflation at 6%. We think that we can get inflation plus 4 in a diversified balanced portfolio. Cash you're getting around 6%. We're escalating the debit orders at 6%. Post-retirement, you're getting a slightly lower return because we're a little bit more conservative, so that's inflation plus 3%. And I've assumed that they both earn an income of around 600,000 when they get to the age of 35. And I'm going to look at 7 decisions. Now, 5 of the decisions relate specifically to the end goal, which is retirement. 2 of the decisions are more sort of insurance-related decisions. So I've decided to combine that as well. So it's not just a pure investment presentation, it looks at the sort of insurance aspect as well. Okay, so let's look at decision number 1. The decision number 1 is, do I start saving for retirement? So the 2 doctors, 25, Dr. Sharp decides, you know what, I'm going to start small, I'm going to start saving 250 Rand now. Dr. Blunt decides, you know what, I don't need to start saving now, I'm going to wait 5 years and spend this money on my girlfriend. Okay, which is, you know,
investment.
yeah, maybe it's also a good investment. The problem is often it doesn't really always work out. And if you look at the cost of that mistake, so it's 250 Rand for 5 years. Actually, if you calculate the impact of that one decision, the cost of that error was over R1 million, almost 1.1 million, just on that little decision. So that's the difference between starting to save at the age of 25, 250 Rand, and starting to save that amount at the age of 30. It will cost you R1 million. So I hope she was worth it, you know. I know when you're 25. Anyway, decision number 2, still at the age of 25, Dr. Sharp engages with his lifestyle planner. He says, you've got to think about your earnings potential, what happens with you, you know, what happens if you're no longer able to practice your specific occupation, decides to buy sickness and disability cover. Dr. Blunt says, you know what, no thanks, I'm going to spend this money on going out, I'm going to live forever, so I'm not going to worry about it. Then at the age of 45, if Dr. Blunt becomes permanently incapacitated at the age of 45, and he doesn't have any sickness or disability cover, he will miss out on 39 million Rands worth of payments over those 20 years. So that's the amount of money that he would need in order to cover his income from the age of 45 to 65. That's a pretty big number. Now, I know we all think we're bulletproof, but things unfortunately do happen. So I'm not going to include that in the overall cost of the area. That's like a once-off thing to say if things don't go well. Okay, so if you don't reach your retirement in a fairly healthy shape. Decision number 3, now we get to the age of 30. Okay, now they're changing jobs. Dr. Sharp says, you know what, I've now accumulated 250,000 Rand in my retirement fund. I'm going to preserve my retirement fund savings. I don't necessarily need access to this money now. I'm going to leave it for what it was intended, which is to fund my retirement. Dr. Blunt says, you know what, I'm not going to do that. I'm going to buy myself a car. Okay. The question then is, what's the cost of that area? Well, we can see that decision cost Dr. Blunt 8 million Rand. But at least he's got a car. Now, if you bought a car 35 years ago today, so this was actually quite challenging. I was looking for a 1980s vehicle. Go to Google 1980s car. That was the best one that I could find. So if you bought that Golf, that's a 1980 Golf. It's 35 years old. That's what you would have. So obviously, I don't think it's worth quite 8 million, maybe 600 bucks. But anyway, that's the cost of that area. Decision 4 now, maybe starting with the family. Dr. Sharp says, you know what, I've got to start thinking about life cover. What happens if I pass away? What will happen to my family? Dr. Blunt says, I'm not thinking about this. And then at the age of 45, one of his parents passes away. And suddenly this whole mortality becomes a reality to him. And he says, okay, I'm going to buy, now I need life cover. I'm going to buy life cover now. And what I did is I said, so at the age of 50, you're obviously a lot healthier, potentially, than you are at the age of 45. So when you buy life cover, then it's a lot cheaper. So what I said is, what's the difference if you buy it at the age of 30, that then escalates, and you buy that amount that it's escalated to at the age of 45 as a 45-year-old? And we then look at the difference in the costs. So Dr. Blunt will pay 140,000 Rand more over that, from the age of 45 to 65. You'll pay 140,000 Rand more than Dr. Sharp for exactly the same amount of life cover. There's absolutely no difference, just because he's waited. And that's assuming he gets it. It's also assuming he's got no loadings or exclusions because his health, because of all the going out and the girlfriends and the cars and everything. That assumes that he's still fit and healthy. Okay. Look at decision 5, which is very often people underestimate the impact of negotiating fees on the investments. So when you have your retirement savings, Dr. Sharp says, I'm going to look at what I'm paying, and he works with his planner to negotiate his total cost of ownership of these investments down to 2%. Dr. Blunt says, you know what, I'm not going to worry about it, it'll be fine, and he ends up paying 4%. Now that 2% per year over from 35 to 65 actually ends up costing Dr. Blunt 3.8 million. It's just paying 2% per year more over a 30-year period can end up costing you that amount of money. Now, you know, it's sometimes I think when you work in financial services, we talk about basis points and low percentages, and people often think, you know, what's the big deal? Actually, that's why we're so obsessed with it, because it has a massive, it's the compounding effect in reverse. We call it the tyranny of costs. Because we know, you know, the lower the cost, the more you end up keeping in your loss. Decision 6 now, there's age of 45. They both get a windfall, so maybe potentially an inheritance. I've said earlier that one of the parents passes away, there's R1 million. And this is something that happens very often in South Africa. Money comes in, Dr. Sharp says, you know what, I'm going to invest it in a balanced portfolio, a diversified portfolio, where I'm getting exposure over a number of different asset classes, potentially a number of different asset managers. Dr. Blunt says, you know what, I'm just going to put it in the money market. So I just don't want to lose it, you know, and just leave it there. Now, I told you earlier that in the money market, you sort of get inflation if you're lucky. In the balanced portfolio, you can get inflation plus 4. Now, the impact of the difference in those returns over that 20-year period is an extra 4 million. Now, over a 20-year period, and you can look at a number of different studies, and I know this is small, but what this graph actually shows you is on the y-axis is the probability of delivering real returns, i.e. the probability of getting a return in excess of inflation, and that is the time horizon. So over a 1-year period, you've got about a 60% chance of getting a real return, whether you invest in cash, bonds, or equities. But what we see is the longer you stay invested, the better your chances of getting a return above inflation if you invest in equities. The same, however, does not apply to cash and bonds, and this is based on something like a 40-year period that they did this analysis on. Because it's over a number of different market cycles. And often we find when we engage with people, they feel safe in money market, but actually what's happening is you're just getting poor very, very slowly, as we can see from what's happened to Dr. Blunt. So we have to take a little bit of risk. And it's not a binary decision whether to go equities or cash. That's why I said I didn't use equities where actually it's inflation plus 6 over a 20-year period. I said let's be a little bit more conservative and invest it across a number of different asset classes. Okay, so now we get to the age of 65. Now we've had how many? Six decisions, 4 of which relate specifically to saving up to this point. The question then is, what do we think the cumulative impact is of all these decisions? Now we've already seen we've seen the numbers. So if we add it all up, what we see is Dr. Sharp now has an investment. There's his investment from the windfall. He has a preservation fund, that's that 250,000 rand that's reserved when he changed jobs at the age of 30. He has a pension fund, which he was contributing to, and where he paid 2% fees. And he has that was the retirement annuity, and he has that investment that he invested in a diversified portfolio. Dr. Blunt didn't, he has a retirement annuity, but he started later. He doesn't have a preservation fund at all because he bought that very nice 1980 Golf. He has a pension fund, but he paid 4%, and he has an investment that gave him a low return. So the overall cumulative cost of all of those decisions is 17 million rand. So Dr. Sharp has doubled the capital at retirement than Dr. Blunt. Now, none of those decisions were particularly massive investment amounts that they invested. It was a little retirement annuity. It was just the contributions to the retirement fund. It was one windfall of R1 million. And I don't put any big numbers in there. But the cumulative impact of those decisions over time actually adds up to a massive, massive amount of money. And this is what we often underestimate. Now, the question is, okay, so now we've got to start making that real. How does that impact their ability to live and maintain their standard of living? This is actually quite scary. Even the good result is still a bit scary to me. So at the age of 65, Dr. Sharp has an income of 20,000 rand per month in today's terms. That's I'm using the present value. That's not, I mean, on 34 million. If you take inflation into account, the actual income that he gets at the age of 65 is only 20K. Dr. Blunt, and that's if he takes 8% of the capital, which is fine. He will probably maintain or be able to maintain his capital, but it's still a bit touch and go. Dr. Blunt says now he wants 10% because even at 10% he's only getting 13,000. Which is also that's also in today's terms. Obviously, if you take 10% of a 17 million rand retirement portfolio, the actual amount will be higher. But actually, in today's terms, it's only worth 13,000. So now there's a decision that they have to make. Do I retire now, or do I work longer? Now, if you look at what's happening is, if you look at the age of 65, in the year 1800, you would have been dead 27 years ago. In 1900, you would have been dead 12 years ago. 2000, you had 12 to 15 years to go. And what they're saying, in the year 2100, which I'm doubtful whether we'll make it, but we'll only be halfway there. And there's some really wacky guys that are saying on the Time magazine, they recently had a cover where they said the first child that will live to be 150 has already been born. Which is actually quite scary, and not just from a physical health perspective, but from a financial planning perspective. We have to change the way we think about retirement and when we retire. And we actually see this specifically in the graduate professional market, where generally speaking, our clients retire much later. They work much longer than the general market, and that's because they're living longer as well. So I think the oldest client we have at PPS who still has their profit share intact is well into his 80s, and his profit share comes into like 2.7 million, but he's still a practicing, I think he's a dentist or something. So people are working much later because they are living much later. Okay, so what is that Dr. Sharp? Dr. Sharp decides, you know what, I'm going to work for another 5 years, grow my retirement capital, then retire. Dr. Blunt says, you know what, I'm going to retire now, draw my capital. So what happens is Dr. Sharp's capital lasts another 37 years until the age of 107, and Dr. Blunt's lasts 40 years. So the net result of all of these decisions, forget about the numbers, just look at the actual impact in retirement, is that Dr. Sharp can draw double Dr. Blunt's income for 23 years longer. Okay, now that's massive, and I think that's how we have to start. We have to think with the end in mind, not with the beginning. We have to think what's going to happen. How long do we think we're going to live? Which is probably longer than we all anticipate. And how long do we then need our income to last in order to maintain our standard of living? Okay, so let's look at some of the lessons that we've learned. Let's go back to the future. Let's work through that. So what have we learned? First of all, time really is money. There's a reason why that thing exists, and we can see that. So just waiting 5 years, and that doesn't just apply to 25-year-olds. I mean, let's face it, I don't know if any of us are still 25. You know, it applies at any age throughout your lifetime. The sooner you start, the better, even if it's a small amount, because that compounding effect over time is absolutely massive. That's why Einstein called it the eighth wonder of the world. Secondly, you are your biggest asset. That relates to that 39 million rand number. That is your ability to earn an income. If anything were to happen to you and you weren't able to earn that income, that is a massive asset that's lost. So we have to think of ourselves as our biggest asset. It's not the golf or the house or the boat. It's actually it's your ability to earn an income for your lifetime. Don't focus on the short term. Okay, so don't invest with the short term in mind. Think about the long-term implications. So that relates to the preserving the retirement fund. Sometimes it's difficult to think so far in advance, but don't think just about fulfilling that short-term need. That talks to the preservation aspect. And there was some research done by Alexander Forbes a couple of years ago where they actually found that something like 75% of people that earn more than 300,000 rand per year don't preserve their retirement fund savings. That's a shocking number. So it doesn't say that people that are earning low incomes don't preserve. It's saying that people that are earning very large incomes don't preserve their retirement funds when they change. It's the single biggest contributor to people not being able to retire in South Africa, is that they don't preserve the money that they've already accumulated in their retirement funds. That's why the government is through the retirement reforms that are looking at ways at trying to force people to keep the money in their retirement funds. That being said, we think it's a long way from that actually coming through, because there are obviously different agendas and political agendas that play there. And there are also different segments of the market that may actually need access to that money for retirement. But that being said, I don't think anyone in this room has to worry about the short term. You have to think about what the actual intention was of the money we put in our retirement funds. Life and death happens, unfortunately. We have to think about those things, and less so maybe when we're younger, but the sooner you start thinking about it, the better, because the sooner you buy it, the easier you're going to get it. You don't have to go through all the underwriting. The way things work with an insurance company, once you have it, the cover will escalate with your premium. In other words, the older you get, the more cover you will have. So don't wait too late to try and get it, because when you really need it, you may not be able to get it anymore, or you will pay a fortune for it. You may end up paying 140,000 Rand more for something, for exactly the same thing that you could have bought 5 or 10 years ago, for much cheaper. Compounding can work against you. We saw that with the fee example. You get those numbers wrong, it starts accumulating against you. And when we talk about fees, and specifically relating to investments, this is where people get very confused. There really are only 3 fees that you can be paying. Okay, there are only really 3 parties at play. There's the advice, there's the administration, and there's the asset management. Okay. And for each of those entities, there's potentially an initial and an ongoing fee. Okay. So from an advice perspective, that fee is negotiable. If you're in a relationship with an advisor, or you're dealing with an advisor, that initial advice fee should always be negotiable. It's not a set fee. The same applies to the ongoing advice fee. That should also be negotiable. That's normally negotiable between 0 and 1%. Okay, that's when you're paying the person to provide oversight over your investments. The second entity is the administrator. That's the person that normally gives you access to the investments. That's your platform or your unit trust supermarket, which we'll also refer to as a list. It's not a speech impediment. It's a investment services provider. So just basically a platform where you can shop around and buy different unit trusts. The fees in that part of the market has fundamentally changed over the last 10 years, where you should not be paying any initial administration fees to any product provider. If you're paying initial admin fees, you're not getting a good deal. And if you are paying an ongoing administration fee, more than 0.7%, you also get a bad deal. So like those of you, they're going to charge you 0.5% for access and another 1% per annum for admin. You've got to go elsewhere. From an asset management perspective, we're also seeing big changes there. That's the person that actually manages the money for you. That's the Coronation or the Anagray or the Investec. You should not be paying any initial asset management fees. Those existed up until 5 years ago. There are still some guys trying to get away with it. You should not be paying an asset manager any initial asset management fees. They used to call it the bid offer spreads, and they charge you 0.25%. No, I want 0. Otherwise, I'm not buying this fund. Okay, and from an ongoing asset management fee, generally speaking, how the fees work is the more aggressive the fund, the more equities it has, the more expensive it is. So you should be paying a lot less for your cash or your money market investments than for your high risk or foreign or equity investments. Okay. Those are the only fees that you should be paying. You should not be paying fees to change your underlying investments, switch. You should not be penalized for trying to move your investments away from where you currently are by some sort of an early termination charge. Generally speaking, you should avoid guarantees, because actually they are not worth the money that you're paying. Why do I say that? Let me ask you this. How many times in the last 45 years have you had a negative 5-year return in the equity market, in South Africa? Negative 5-year return in the last, since 1970. The answer is 0. So you've never had a 5-year, well, not never, you haven't had a 5-year return in the last 45 years. Generally speaking, guarantees have a term length to them, which is normally 5 years. What you have to pay for that guarantee. You generally don't get the dividends of the underlying investments in the guarantee, and you get a nominal guarantee. So it means that you won't lose money, but it doesn't say that you will protect your money against inflation. So instead of buying a guarantee, you can go and invest in a fund from a Coronation or an Investec or a Prudential that says they target a return of inflation plus 4. So it's not explicit, but it's implicitly applied that they're going to try and get you inflation plus 4. You're not locked in for 5 years, you can change whenever you want to, and you're not paying an additional fee for that guarantee. So generally I would avoid paying fees for guarantees. So just in terms of managing our costs, those are the 3 parties: that the advisor, the administrator, the asset. Remember, think of the 3 A's. Generally speaking, avoid initial fees. Maybe the advisor charges an initial fee for the planning that they do, but the admin and the asset management, no fees. And on an ongoing basis, the advice fee has to be negotiable, and the admin fee has to be less than 1, and the asset management fee has to be related to the actual risk that the asset managers take. Okay. So be very careful when you're dealing with fees, because that compounding has a massive impact. I can show you now 3 million on our specific example. Avoid reckless conservatism. It's rife in South Africa. People love money markets, and the moment they get scared, they switch all of their money out of the diversified portfolios into the money market. We call it reckless conservatism, because you may feel safe, but actually you're not safe. It's actually riskier to be in a money market fund in the long term, because your volatility or your risk in nominal terms might be low, but your volatility in terms of inflation is extremely high. It's actually less in an equity fund. So if you have more than 7 years to invest, generally speaking, you can take on, you should almost invest 100% of the money in equities. The reason why I'm saying why I haven't used that in my example is because there is a timing element, and rather let the portfolio managers go and do the timing for you than you try and do it yourself, because I showed you earlier, we are actually pretty terrible at timing the market. Okay. Number 7, retirement is just a tax event. That's all it is. Just the day that you decide, okay, I want this money, then there's a tax event that happens where they say, if you're in a pension fund, you can take a third, you have to annuitize 2/3, or if you're in a provident fund, you can take the full 3/4. You don't have to retire. You can work longer if you want to. And generally speaking, that's actually when your money can really work hard for you. So just an extra, you saw in my example, Dr. Sharp working an extra 5 years, it actually boosted his income for the rest of his life by 25%. So he went from 20,000 a month to 25,000 a month just by working an additional 5 years. So don't, and it's often when we think about the type of planning we want to do, is asking someone for a retirement age is a bit strange. Most people don't know when they want to retire. They want you to guide them. Tell me when I can retire. Okay, don't ask me. I don't know. You tell me when I can retire. Okay, so these are some really, really important lessons. A couple more concepts that I want to share with you that will help you protect you against making these mistakes. The first thing is, in South Africa, we have a pretty negative outlook on financial advisors, but often they are the only thing that stands between you and a very big mistake. Okay. So we have to think about engaging with people that can assist us with these decisions, because they may seem easy to deal with, but actually they can get a bit complicated. And there's a new type of financial planning that's coming into South Africa. It's called lifestyle-based planning, that actually says financial planning is not just about your money. It's actually about that place where your money and your life intersects. It's really about understanding what your life goals are, and then talking to a person that can relate to what you currently have from a financial perspective to assist you in achieving your objectives. That's real financial planning. It's not a guy that's trying to sell you the latest product that their company has bought. That's not real financial planning. It's sales. And there's a big shift happening in South Africa away from sales both from a regulatory aspect, but also from a general, things are changing. Consumers are more educated. You guys are more educated. You're asking more questions. So why would you want to pay someone to sell you something? You want to pay them for actually listening to you. So I use the analogy of the doctor. When I go to the doctor, I don't walk in and the doctor says, hey, I've got to sell you this new medicine. Walk in and the doctor says, what can I help you with? He listens to me. He listens to what my issue is. Then he'll ask me some questions to try and ascertain my health, my physical health. And then he'll give me a diagnosis. Okay, so that's real financial planning should work like that as well. The person should listen to you first, then ask you some questions to try and ascertain your financial health, and then give you a diagnosis. And a diagnosis that you can understand. Not a plan with lots of complicated numbers and graphs and terms that you can't understand. That's also the next step in the evolution. That's what is called lifestyle planning that actually relates to you. It talks about this sort of sophisticated simplicity. So often when we deal with things, it actually gets very complicated and it seems like it's too much to deal with. And then you go to the advisor and then it gets complicated. You thought it was confusing before you engaged. Now that this person tries to explain to you that it's actually even more complicated than you thought it would be. So I think that the shift is about making things understandable for people and relating it to their main objective, which is really just that maintaining or improving your standard of living. And the key value add of a good financial planner is someone that can assess your entire situation. Even if you approach them just with one issue, they can look at you holistically and then guide you in a certain direction. I'd like to thank you very much for the opportunity to talk to you. We've still got 15-20 minutes for questions. More than happy to take any questions. Thank you very much. Any questions?
Yes. What is your medical aid type of contribution to the whole plan? Because you didn't actually mention it.
Medical aid contribution is very much part of your day-to-day sickness management. So what I did is I assume that is part of your normal monthly expenses.
Is there any rule of thumb of your net salary or net income that you should be
contributing to your retirement savings? So I use the contribution of 12.5%, which is generally speaking too low. So the general rule of thumb is that you should be saving. You need around 75 to 80% of your final salary in order to sustain your retirement.
We're talking gross.
Yes. That's sort of what you're looking at. But what we're finding is because people are living longer. Because people are living longer, that number is actually a lot higher. It's more than that. So, and the thing is, I guess, is that you've got to make it. Every person has a different number.
Yeah.
Because every person has a different standard of living that they're trying to manage. So you've got to go and calculate it specifically for you.
But you're finding that companies are making the retirement age earlier rather than later?
There are some companies that have extended their retirement ages, but you see, one of the things we're also dealing with is in the old way of doing things was the so-called defined benefit scheme, where the employer would actually fund your retirement for the rest of your life. Those were actually very, very good schemes. And in South Africa, we got rid of them extremely quickly, which basically what we did is we said we're taking the onus away from the employer and putting it on the individual. So now you are responsible for managing your own retirement income. So in the defined benefit schemes, it's very unlikely that they'll make the retirement age earlier because then they've got to fund you for longer. So generally they'll make it older. With the defined contribution, I would say generally speaking, retirement ages in South Africa are too low. So between 60, even 65, I think is low. What we're seeing in the developed countries is they're starting to push up the retirement ages. So they're making, they're shifting
That's for another reason. That's because of affordability.
Yeah, that's the defined benefit.
It's shrinking.
Yes, yeah. A lot of the European states still have defined benefits where they're worried about the costs to the employer. Any other questions?
you find the younger generation more cynical about insurance and what you tell them than my generation who started working in the 1970s, because I believe at that stage we almost unquestioningly bought insurance from Old Mutual and Sanlam. And in about my 55s, some of them started cashing in, and I had a cumulative return of 8%, whereas if I looked at my house, and now that had appreciated over the period in 15% without extending it. And so the type of message that I give to my children is very cynical.
It's a bad deal, yeah. Unfortunately, yes, times have definitely changed. And I think you're right, millennials are very skeptical of not just insurance, even investments. So there's some very interesting studies that they've done in the States around millennial investment behavior. And some of the things that come out is that they are very cynical of the market in general, especially of people that proclaim to be able to get good returns on the market. So they're driving this shift from active management to passive management. They are obsessed with fees, and I think that also comes from their parents. So I'm not going to pay you more than I think you're worth. I'll just get it from my passive manager. From an insurance perspective, most definitely. So, I mean, we know 20, 30 years ago, everything was based on trust. So when you bought a product from an insurance company, then you did it based on trust. And that's changed. So products are a lot more transparent now. And you can even look at the way the products were designed 30 years ago. They were very opaque. You didn't really know how the money was being invested. They were quite rigid, so you couldn't really move out of them if you wanted to. They were pretty much built for the guy that was going to sell them. They were very lucrative for people to go and sell, which is why a lot of people, preachers and teachers became financial advisors, because there was just more money in it. The way things are working now, it's a lot different. So the product design today is transparent. You have to disclose to people what you're charging. I'm not saying it's like that everywhere, but the new products that are coming into the market certainly work that way. I'm not going to lie to you, it's a challenge. It's a challenge. The main challenge, I think, for the financial services industry is actually just getting people in. Because, even though Dr. Blunt paid 2% more than Dr. Sharp, at least he had something. At least he was putting something away. It's definitely, I think the way we engage with people is also different. So a lot of the work that we've been doing suggests that you can no longer define a client as a distribution channel. This sounds very weird, but it's actually, a lot of financial services companies think of you guys like a distribution channel. Either you're going to buy stuff from me directly, or you're going to buy it from me through some sort of an advisor. Now, as human beings, we don't really operate like that. Some of our things we may want to buy directly. Some of the things we may want advice. And we'll dip in and out of advice as our situations change. So there's a big onus or big pressure on financial services companies to actually change the way in which they engage with people. So yes, if you want to deal directly, I should actually give you something. I should give you some sort of an online tool to go and do some work yourself. And then when you need me, I'm here for you. Now, we're not quite there yet, but the thinking is definitely starting to change.
Just to add to that, because as a younger generation, in the circles that you operate, everything is being done online. And the bigger companies advertise, you don't have to work through someone. So I think if you go on Coronation and Grammy, it's very easy to follow steps to actually get yourself a policy or investment.
Yeah.
But I mean, I think the challenges are that you really have to make the right decision to what specific portfolio you invest. That's challenging for you to get overwhelmed with marketing on how you can do everything yourself as a young professional.
Yeah. And yeah, I mean, I think there are two big things happening. First of all, the regulators definitely getting involved, very involved. So they're saying they're going from a rules-based more to an outcomes-based approach. So they're saying even if you tick all the boxes, we're still going to know if you have the wrong intentions. So you've probably heard of treating customers fairly and the retail distribution review. These are all things that will empower the consumer. That's the first thing. This online thing is another very interesting thing. A lot of companies see the so-called robo-advisor or the online-based thing is a massive threat to their business because you're just going to go online and do it yourself. Yes, I think there's a big, that's definitely, there's a massive market for that. But what we are also finding is that people still want to engage with another person. There are some things that I'm quite happy to do myself. So if I want to save 250 Rand a month, do I really need a whole plan? You know, can't I just go online and do it? But then when it gets to thinking about my estate planning, what happens when I die? Do I have enough liquidity in my estate so I don't have to sell my house, or my wife doesn't have to sell my house to pay the estate duty? That stuff is a bit more complicated. Then you probably want to talk to someone. And I think the challenge that we have as people advising clients is that we have to lift our game. We have to act differently. Because if I approach a young person and say, look, I want to sell you a life policy, I don't need a life policy from you. I'm not going to buy from you. You've got to show me the value add. And I think that's where the shift still needs to happen, is a lot of people are obsessed with costs, but they're not actually looking at what is the value. What's the value that you can add? And that's the challenge that we face inside. Yeah.
I'm also one of those very skeptical about life cover. And because for me, it doesn't benefit me.
Okay, so I'm gonna you're right. What if you live? Okay, so I don't want to do too much of it fun, but the one thing about PPS is the fact that it's a mutual business. I'm not sure if you guys know how it works, but basically, mutual company, there are no external shareholders. So when you buy a product, you become a shareholder. What that means, if you buy life cover, you get profits on that product. So if you don't die, you actually get something at 60. So there is something available for people that, you know,
you must just hope that your partner doesn't think like it as well.
yeah, that's true. But the thing is, and I think life cover, yeah, you're right. I mean, it depends on your specific situation. That's why I said the other big shift, by the way, is this whole one-size-fits-all story doesn't work anymore. People want, it's got to. We don't even want to watch what's on TV anymore. We want to stream stuff that we like. I was in Joburg yesterday on iFelt. They've got listener-driven radio. So people call in and say what they want to listen to. And I think the same applies with financial systems. Don't give me this poppy. I want to pick and choose the things that I want, and that's what I'm willing to pay for. So that I completely get big up. The old days, they bundled everything. You've got some life cover and some investments, and the one subsidizing the other one, and you never really know what you're paying for what. I think those days are gone.
Just a quick one. How do you see property as part of your retirement portfolio?
I think property is definitely a part of your overall investment portfolio. But what I would warn against is, it's less so now, but a couple of years ago we saw massive interest in property type investments, especially property syndication. There's nothing wrong with property syndication in principle. There's nothing wrong with investing in property, but I think we've got to be very careful of putting all of our eggs in one basket. So my argument is almost the same for property as it is for cash. Yes, property is a good investment. I think, you know, we can debate whether fixed property is better than listed property. I have a certain view, but you know, property also goes through cycles. So it's actually going through a pretty bad cycle at the moment. It will probably get worse when rates go up, because property generally behaves like bonds when rates go up, which means that the prices come down. So I guess my short answer is yes, as part of a broader portfolio, property makes good sense, but don't put all of your eggs in it.
I think one should just distinguish there between lifestyle properties, like your primary house,
yes,
and your holiday house.
Yes.
Because on residential, you're getting 7-8% returns, but if you have a holiday house and you're letting it out, your returns are about 2%. And the market's also very much more volatile in the holiday houses.
Yeah, look, there's lots of different ways of accessing property. That's why I mentioned that actually physically owning a property has its pros, but it has a lot of cons as well. It's difficult to get in, it's difficult to get out. There are all sorts of costs like, you know, transfer duty and things that you've got to take into account. Plus, you're only invested in one specific part of the property market. Listed property, which is listed on the JSE, actually gives you exposure to lots of all the segments of the property market. Commercial, office, residential, all of it, and they don't go. They go through different cycles at different times. So they don't always behave the same at the same time. So you're getting good exposure.
So,
Yes.
Can I ask you your comments? I mean, there's opposing advice over 5 years before retirement. One say you must become more conservative to get your yield you want. The other one I've heard is that, well, now your absolute value is probably at the biggest, so that 5 years can double it.
Yeah, that's a very good question. That is actually one of the big misconceptions in South Africa, is that the closer you get to retirement, you should end up with something in cash. That works if you're going to die in 5 years' time. If you're going to live another 30 years, you actually need something that will give you inflation plus. Because if you want to draw, say, an 8% income, okay, now you've got to assume there's 2% fees, eh? So to get your 8% in your pocket, you've got to generate 10%. To get to 10%, you need inflation plus 4. You're not going to get that in a very conservative investment. So I think the answer is we have to, once again, it's not binary. It's not, okay, go full on with when you get 5 years, but you have to sort of keep the money or the risk on the table. And that's why I said it's just a tax event. It's not like this, and then you stay there. One of the biggest issues we've seen is that people go into retirement and they put all of their money into income funds or money market type funds. Income is just one level higher, but then you get no exposure to the equity market. It's all fixed income. And those people have been decimated because your income fund now gives you 6%. So 6% and you're paying 2% fees. Yes, if you draw 8 income and you're drawing 10, you're getting 6. You're going backwards. So yes, you have to keep that risk on the table, but it's managed risk once again. But that's a good question. I think people often make that mistake.
Going back to the example with Dr. Blunt and Sharp. Assuming Dr. Blunt at the age of 50 recognizes the error of his ways, what can he do between 50 and later to redeem himself?
Yeah. So are you referring to, is he an advocate? No, I'm joking. It's a very real example. We often find that with advocates, they've got a different life cycle. They start making more money later in life. There are a couple of levers. Okay, so the first thing is you can save more. That's really the first thing that you can do.
Can I add something there? Yes. Can I add that the guy makes $500,000 a year? Just as a number.
Okay.
So let's say in that position is capping off at $500,000, but he needs to get somewhere. So just
okay. So he's not making 5 more.
He's making big money.
Okay. So he's a struggling advocate. Okay, so let's do that. So okay, first thing is whatever you're earning, save more. That's the first thing. You have to try and up your return. If you're 50, you still have 15 years left. You've got to up the risk in your portfolio because you need to get more than that 10% that I was saying. You've got to get more than inflation plus 4. If you have 15 years left, you can go more risky actually. It's like I showed you that line with the equities, cash and bonds, you can take more risk. That's the second thing that you can do. So either change the amount, increase the return, or increase the term. And how you increase the term is by saying to yourself, okay, because I'm starting later, I'm willing to commit to work a little bit longer. The fourth one, which is the one that's least popular, is that you've got to say, I'm going to change my standard of living. That's the reality. But it's basically one of those 3 things, or 4 things really, that you can use to make it up. There's no silver bullet. And I have another presentation that talks about the 7 deadly sins of investments. And one of the sins is this idea of a free lunch or a quick buck. Those things just don't work. But we still see them in South Africa today. There's lots of them. You watch rugby and you check these guys guaranteeing you 15-20%. How do you get 15-20% in this market without taking risk? So be very, very careful. We often find doctors, I don't know who they are, you don't have to raise your hand, but they love these schemes where, get rich quickly, make money quickly. It doesn't work like that. Just read any Warren Buffett book. Yes.
What's your view on active versus passive managed funds, and is it a good strategy to have a combination?
Yes, that is exactly the strategy. So they both have a role, and if you do some analysis, what you find is that passive managers perform really well when the market's running, okay, relative to active managers. But when the market declines, because your active manager generally holds positions that look different to the benchmark, they perform much better. So what we say is, because it's so difficult to call when the market's going to turn, it's a good strategy to have a combination of both. The other thing that I will say about passive is that passive is changing a lot. So passive in the old days was you basically just own the market. The passive is getting a lot more sophisticated, so you have the so-called smart beta, where they try and replicate the index, but not necessarily based on the size of the companies in that index, based on other things. So they might look at sort of the dividend yields and recreate a benchmark of companies with very high dividend yields, which actually looks a lot more like an active fund, but it's passive. There's no qualitative oversight. They just invest it and leave it. So yeah, I think passive is definitely a strategy worth considering, but I get extremely worried when I go to Cape Town International and you walk down that ramp and there's a big sign that says passive manager X, 16% over the last 10 years. And people go and they put all of their money in there. Given where the market is now, that is absolutely shocking. And I'll tell you why, because most of the big passive, so I'm not talking against passive again, most of the big passive managers in South Africa are still market cap. So one of the biggest shares in South Africa now is Naspers. Naspers wasn't even in the top 40 10 years ago. So if you bought that index, you are now, because it's growing, you are buying more Naspers at these higher levels. And you're going to start selling, and you've sold platinum. Minus they out of the top 40. There used to be 10% of the index, they're now gone. So you've been selling platinum through this decline. It's not a great investment strategy. But yeah, there is a place for them still. When the market's trending upwards, it's a good strategy because you're buying into strength. You're going to be careful, especially where we are now.
Just regarding diversification, seems to be the buzzword, probably equity, bonds, cash. Often hard assets is forgotten about. And by that I mean investing in gold, which is counter-cyclical.
Yeah.
Do you have a view on Kruger Rand?
Gold is a tough one. I assume from the question you're a gold bull, so I'll try and. I think gold is not a bad investment at the moment. I think there's definitely a place for gold, especially when the market starts getting concerned about the dollar. I'm not convinced that necessarily where we are now, those concerns are that justified. As a long-term investment, definitely. But once again, as part of your portfolio. And there are different ways of getting it. So you can get it through a Kruger Rand. You can actually buy an ETF that holds Kruger Rands as well. There's another people. So the new Rand ETF is actually like buying Kruger Rands as well, just in case you're thinking of another way of getting access to gold. Glad you didn't ask me about platinum, man. That's a whole other story. Sorry, sir. It's just a gentleman behind you.
How do you see equities in South Africa over the next 10 years?
I think the equity market is expensive, and what we're seeing is the massive divergence in terms of the valuation of resources versus industrials. So if you break it down and you say you've got resources, financials, industrials are expensive. Okay, and I mean you can't. It's like weird when you read some of these articles where they try and justify a price earnings ratio of 106. That basically means you're going to wait that you pay for 106 years worth of earnings. Now that story sounds familiar. I don't know if some of you were around in the late 90s financial data. It's like 100, yeah? That sounds familiar. I'm not saying the same thing's going to happen, but I'm saying, are you willing to pay for 106 years worth of earnings? That's expensive. Resources, on the other hand, have been absolutely hammered. Okay, so they are very cheap. Some of the asset managers we're talking to are saying that you can buy Anglos at resources are at 50-year lows. If you look at the evaluation relative to industrials. So looking at the market now is actually quite difficult. So as a whole, it's expensive, but it looks expensive because of the industrials. If you look at the resources, they're very cheap, which is why a lot of managers have started buying, a lot of active managers have started investing in resources.
Anglo looks like it might be dying.
Yeah, the mines is a very difficult one. So if you take the platinum mines, if you take, say, a business like Alignment, for instance, where from an investment perspective, they've spent a lot of money sinking the mines, getting everything in place, and then Marikana happened. So they've spent a lot of money without getting the earnings. Now they're ready to get the earnings, but unfortunately now the market's turned against them. And what a lot of the guys are saying, platinum has been hit too hard. So when that starts coming back, these guys are perfectly positioned to leverage, to benefit from it, because they've paid the fees, they've already sunk the cost. Whether that's going to happen is very, very difficult to call, because you've got a lot of external factors that you're having to deal with. That's difficult from an investment perspective to value. So it is a tough one.
Yeah, thank you, sir. It's we have to cut. I'm sorry for that. As you said, I like one of the things that is you put there, saying that time is money. That's why. Yeah, and another thing, I've been with the financial planners, that is a lot. They say time is money, but once they start talking about money, they talk all the way. Till you can, yeah. Nico, on behalf of the alumni and the USP Business School, we want to thank you, for your time and your the presentation. And when I was asked to come, that is and thank you, and the topic that is and everything, I expected an older that is a guy, professor with a PhD that is an older person, and not a youngster that is like you. We are very proud that we are one of our own. You started here, that is at the University of Stellenbosch. I've seen that is your CV. But now I was asking what did you want at UCT, and what did you want at the University of Free State? and I understand you now, that is as an investor, you said you don't put your head. So, it worked well, that is for you. The way you look, when I was sitting there, the way you talk, that's I think I said, no, this guy, no. He should be born free, born after Mandela, that is not because your ideas contradicts everything what we thought that is a mistake. And I want to thank that lady that is there who really asked this. That was the real question. Of all questions asked, that is you. We were being told about these two doctors, 25, that is in 30 years. Then like me, what happens? What is the cost after you meet a financial plan after 50 years? That was a very good one. How do you recover that is from there? Yeah, we thank you, that is a very much, and it's an input. But just to add on is that I think your audience, that is the most, should be really the upcoming local, that is a generation. I was looking at the faces here. They were just like mine, because people were worried when you were talking 25, that is a 30. That is a lot, and I think most of us, that's probably started, that is a very late. But the last question helped us, that is you can steer and you can
never do that.
Yes, we can do that is a very much. And at the same time, the fast track, I wanted to ask you, that is the question that we were one of the 11 people, that is by Sangam, who was elected, that is to do the fast track. How did it contribute, that is to your
massive?
Yes,
I was very fortunate to get exposure to very senior people at a young age.
Yes.
And it had a massive impact on my own personal development, because it just allowed me to see the bigger picture, I guess.
So now we'll just give the clap of hands for yourself for being here. And one more thing, just to finalize, let's give him sorry.
Dit is een goede
Hey,